Thursday evening, March 25th, 2021. The blue glare of monitors illuminates the exhausted faces of Wall Street's most powerful prime brokers. It is a hastily arranged, highly secretive video call. Representatives from Goldman Sachs, Morgan Stanley, UBS, Nomura, and Credit Suisse stare at each other in absolute silence. The atmosphere in the digital room is suffocating. They are looking at a mathematical impossibility. A single client, operating out of a quiet family office in Manhattan, has secretly built up $160 billion in gross market exposure. And tonight, the market has turned against him. He is entirely out of cash. The banks on this call are the ones who lent him the money. They hold his stock as collateral. The paradox is terrifying. If they all panic and rush to the exits tomorrow morning, the sheer volume of dumped shares will crater the global stock market, guaranteeing multi-billion-dollar losses for everyone in the room. They are chained together to a bomb with a ticking timer. And the man who wired the explosive is a convicted insider trader named Bill Hwang. The head of equities at Credit Suisse breaks the silence. He proposes a standstill agreement. He says to the screen, "If we agree to hold our positions, we can quietly sell the shares over the next month, absorb a manageable loss, and prevent a market catastrophe." He looks for nods of agreement. It is a classic prisoner's dilemma. If everyone cooperates, the damage is contained. If one betrays the group, the betrayer survives, and the cooperators are slaughtered. Credit Suisse waits for a gentleman's agreement from bankers who have no gentleman among them. The executives from Goldman Sachs and Morgan Stanley nod politely on the screen, but their internal chat rooms are already flashing red. The risk officers at the American banks calculate the exposure. They realize Hwang is completely tapped out. The scent of blood is in the water. If you want to understand the mechanisms that actually run the global economy and the ruthless incentives driving these boardrooms, hit subscribe and join the few who see the financial system for what it actually is. The betrayal is already underway. While Credit Suisse sleeps, convinced they have a truce, the mechanism of shadow leverage begins to unravel. To understand the panic, you have to look at how Hwang built the bomb. He did not buy stocks with his own money. He used a derivative trick to rent the economic exposure of the shares. For every $100 million of stock Hwang controlled, he only had to put down $10 million in cash. The prime brokers on the call provided the other $90 million. Because of this massive leverage, any slight drop in the stock price meant Hwang's initial cash was instantly wiped out. By the time the video call ends, Hwang has vaporized $10 billion of his own personal wealth in less than 48 hours. The banks are staring at a massive hole on their own balance sheets. The underlying collateral is dropping in value by the minute. The institutional trust that glues the global banking sector together is completely dissolving. Credit Suisse is about to learn a very painful lesson in counterparty risk. Before the sun rises in New York the next morning, Morgan Stanley and Goldman Sachs silently break ranks. They do not wait for the market to open. They go directly into the dark pools, the private trading venues hidden from public tape, and begin aggressively liquidating $20 billion of Hwang's collateral. They offer massive blocks of shares at heavily discounted prices to any hedge fund willing to take the other side of the trade. By the time Credit Suisse realizes they have been played, the public markets open and the stocks go into a terrifying freefall. Millions of shares are dumped every minute. The Swiss bank, an institution with a 167-year legacy of financing the Swiss railway system and surviving 2 world wars, is left holding an empty bag. In a matter of hours, Credit Suisse suffers a $5.5 billion mortal wound. How did an army of risk managers, armed with state-of-the-art algorithms, completely miss a $160 billion iceberg floating right in front of them? New York City, 2013. The offices of Archegos Capital Management are quiet, heavily funded, and entirely unregulated. At the helm sits Sung Kuk Hwang, known to Wall Street as Bill. Hwang is a former tiger cub, a protege of a legendary hedge fund. But he comes with a massive red flag. Just 1 year prior, the United States Securities and Exchange Commission charged him with insider trading and manipulating Chinese bank stocks. Hwang pleaded guilty to wire fraud, paid $44 million in fines, and was banned from managing public money. For most traders, a wire fraud conviction is a career death sentence. For Hwang, it is merely a minor pivot. He understands that the financial system is built on specific regulatory definitions. If he changes his definition, he changes his reality. He stops calling his firm a hedge fund. He rebrands it as a family office. And by doing so, he steps through a massive, perfectly legal loophole left wide open by the government after the 2008 financial crisis. He becomes invisible. The government regulator says we need to aggressively oversee hedge funds to prevent another market collapse. The financial lobbyist replies, "We agree, but you cannot possibly regulate a private family managing its own inheritance." The regulator agrees and writes an exemption into the Dodd-Frank Wall Street Reform Act. Family offices are notoriously exempted from registering as investment advisors. Because Hwang is only managing his own personal fortune, estimated at $200 million at the time, Archegos operates in a regulatory dark pool. He is not required to file the public disclosures that hedge funds must provide to the government. He has no outside investors demanding transparency. He answers only to himself. But $200 million is pocket change in global equities. It is not enough capital to move the markets or achieve the astronomical returns Hwang demands. To scale up, he needs access to prime brokerage leverage. He needs the big banks to lend him billions. Initially, the compliance departments block him. They look at his wire fraud conviction and flag him as a severe reputational hazard. The mechanism of Wall Street memory erasure is fueled entirely by commission fees. By 2020, Archegos is generating tens of millions of dollars in potential revenue. The business divisions at the major banks look at Hwang's trading volume and realize they are leaving money on the table. The prime brokerage business is a high-volume hustle. Banks generate massive profits by charging financing fees on leverage and executing trades for aggressive clients. The sales teams begin aggressively lobbying their own risk departments. They argue that Hwang has paid his fines and learned his lesson. One by one, the doors unlock. Morgan Stanley, Nomura, UBS, and ultimately Credit Suisse welcome him back to the trading floor. Eventually, even Goldman Sachs capitulates, overriding their own internal compliance blocks. The banks willingly hand the keys to the armory to a convicted market manipulator, simply because the quarterly fees are too intoxicating to pass up. And the weapon Hwang selects from the armory is a synthetic derivative designed specifically to bypass federal ownership laws. When you buy 5% of a publicly traded American company, the law requires you to file a public declaration known as a Section 13D with the government. This rule exists to prevent secret corporate takeovers and unchecked market manipulation. It ensures transparency. Bill Hwang wants to acquire massive, controlling-level stakes in major media and technology companies, but he refuses to let the market or the regulators see his footprint. He knows that if he buys the stock directly, his name will trigger the alarms. So, he decides he will not buy a single share of stock. He will use his newfound access to the prime brokers to execute a massive, covert acquisition strategy using entirely synthetic contracts. He finds a way to control 20% of a public company while legally owning 0% of it. He is about to build a $160 billion empire made completely out of financial smoke, and his prime brokers are going to help him light the match. New York, late 2020. The trading desks at Credit Suisse's Prime Services division are processing massive orders for Archegos. The strategy relies entirely on a synthetic derivative instrument called the total return swap. Hwang is zeroing in on a handful of specific media and tech stocks, including Viacom CBS and Discovery. The trades are massive, moving billions of dollars at a time. But if you look at the public ownership records for Viacom, the name Archegos Capital Management does not appear anywhere. Instead, the records show that Morgan Stanley, Goldman Sachs, and Credit Suisse are the largest buyers of the stock. To the outside world, it looks like standard institutional investment. The public assumes the banks are bullish on legacy media. But the banks are merely acting as proxies. They are holding the actual shares in their own vaults, perfectly shielding Hwang from public scrutiny. The total return swap is doing exactly what it was designed to do. It separates the economic reality of the trade from the legal ownership of the asset. The transaction happens through a simple agreement. Hwang says to the prime broker at Credit Suisse, "I want the financial exposure of 1 million shares of Viacom, but I refuse to physically buy the stock." The banker replies, "We agree. We will go into the open market, purchase the 1 million shares ourselves, and hold them on our own balance sheet. We will pay you all the profits those shares generate. In exchange, you pay us a standard financing fee, and if the stock price goes down, you must pay us the difference." Hwang agrees. For Archegos, this contract offers devastating advantages. Because Credit Suisse physically buys the stock, the shares are registered in the bank's name. Hwang legally owns 0 shares, meaning he never triggers a Section 13D filing. He remains completely invisible to the government. Furthermore, Credit Suisse only requires him to post 15% in cash as initial margin. With $15 million in cash, Hwang synthetically controls $100 million worth of stock. The bank provides the remaining $85 million in shadow leverage. The true danger of the total return swap lies in compartmentalized blindness. Hwang does not just execute these contracts with Credit Suisse. He executes them simultaneously across half a dozen different prime brokers. He builds a $5 billion position in Viacom through Credit Suisse, another $5 billion position through Morgan Stanley, and another $4 billion position through Goldman Sachs. No single bank knows what the other banks are doing. The system is designed without a centralized clearinghouse for these specific derivatives. Imagine a man taking out a massive mortgage from 6 different banks to buy 6 different mansions, and none of the banks check his credit report with the others. Each bank looks at Archegos and assumes they are the primary lender. Through this mechanism, Hwang transforms his initial $200 million into a staggering $10 billion in personal equity by late 2020. He leverages that $10 billion up to command a gross market exposure of nearly $160 billion. Archegos is no longer just a large client. It has become a systemic whale, entirely hidden in the dark waters of the derivative market. Hwang commands up to 20% of the total public float of several multi-billion-dollar companies. Because he is using leverage ratios of 10 to 1, and sometimes 20 to 1, his portfolio is highly combustible. A minor correction in the stock market would trigger immediate demands for cash from his brokers. Yet, inside Credit Suisse, the alarm bells are being systematically disabled. The internal limits designed to cap exposure to any single counterparty are continuously breached. At one point, the internal software flags Archegos with a potential exposure metric of $2.5 billion, which is more than double the bank's strict internal limit. The risk department sees the flashing red warning on their screens. They have a choice: enforce the limit and force Hwang to sell, or ignore the warning and keep collecting the massive fees. The choice they make will ultimately destroy the entire institution. Zurich, Switzerland, the headquarters of Credit Suisse. The risk management department is supposed to be the immune system of the bank, designed to identify and eliminate toxic exposure. But the corporate culture has mutated. The prime brokerage division in New York is desperate to climb the Wall Street league tables. They are tired of playing second fiddle to Morgan Stanley. Archegos is a cash cow, paying tens of millions of dollars in fees annually. The business executives view the risk officers not as protectors, but as obstacles to revenue. According to a scathing 165-page independent audit later commissioned by the bank's board of directors, the risk systems at Credit Suisse are practically archaic. They suffer from a lackadaisical attitude toward downside protection. The business side prioritizes revenues over basic arithmetic. When the risk analysts attempt to tighten the leash on Archegos, the sales executives aggressively push back. They are terrified of losing their golden goose. The tension between risk and reward reaches a breaking point over a mechanism called dynamic margining. The risk analyst looks at the concentrated positions and says to the sales executive, "We need to switch Archegos to a dynamic margining system. This portfolio is dangerously volatile. We must demand 30% collateral instead of 15%. The sales executive takes this demand to Hwang. Hwang balks. He tells the bank, "If you increase my margin requirements, I will simply close my accounts and move all my business to your competitors." Terrified of losing the massive commissions, the co-heads of the Prime Services Division intervene. They overrule their own risk managers. They decree that Archegos will remain on static margin rates. The bank voluntarily disarms its own defense mechanisms. The risk analysts are told to stand down. By surrendering to the client's threats, Credit Suisse guarantees that they do not hold enough cash collateral to cover a severe market downturn. But the most damning forensic failure is not just the lack of collateral. It is a massive blind spot regarding the actual nature of the collateral they are accepting. The bank has stumbled into a lethal trap. The trap is known in financial forensics as wrong-way risk, or double jeopardy. Hwang is highly concentrated in just a few specific stocks. Because he is buying so much volume across so many banks simultaneously, his own buying pressure is artificially inflating the price of these exact stocks. As the price of Viacom CBS goes up, the value of the total return swap contracts goes up. Credit Suisse is contractually obligated to pay Archegos the cash profits from this price appreciation. Hwang then takes the cash profits that Credit Suisse just handed him and uses it as margin to buy even more swaps on the exact same stocks. The collateral Archegos posts to the bank is directly tied to the inflated value of the very stocks the bank is holding. If the stock price drops, not only does the value of the bank's collateral plummet, but Archegos will have absolutely no independent cash to cover the margin call. It is a self-feeding, highly explosive loop. The bank is financing its own destruction using artificial gains. By January 2021, Archegos is operating at a scale that defies financial physics. Viacom CBS, a legacy media company struggling in the streaming wars, started the previous year trading around $12 a share. Driven entirely by Hwang's relentless synthetic buying, the stock skyrockets to over $100 a share. Wall Street analysts are completely baffled. The fundamentals of the company have not changed. Short sellers begin betting heavily against the stock, assuming it is a massive bubble. But every time the short sellers drive the price down, Hwang steps in and buys the dip. According to federal prosecutors, on certain days, Archegos accounts for over 30% of the entire daily trading volume of Viacom CBS. Hwang has effectively cornered the market. Because the banks are hoarding the physical shares in their vaults to hedge the swap contracts, the free float is shrinking drastically. He creates artificial scarcity. His personal wealth breaches $35 billion on paper. He is completely unstoppable. Until the company he is artificially inflating decides to cash in on the illusion. Every financial bubble requires a pin. The pin that bursts the Archegos bubble is forged by Viacom CBS itself. Monday, March 22nd, 2021. The management at Viacom CBS looks at their stock price trading above $100. They know the valuation is completely detached from reality. They view it as a gift from the heavens. Eager to raise capital to fund their new streaming platform, the executives announce a $3 billion secondary public offering. They are going to issue millions of brand new shares to the market. In a normal environment, a secondary offering causes the stock price to dip slightly due to dilution. But Viacom's announcement triggers a completely unexpected, violent chain reaction. Institutional investors view the massive stock offering as a desperate cash grab. Demand for the new shares is incredibly weak. To get the deal done, the underwriters are forced to price the new shares at $85, a massive discount to the current trading price. The artificial floor holding up the stock completely shatters. The market opens on Tuesday, and the stock plunges 9%. The prime broker algorithms register the drop. The computer system alerts the risk manager. The collateral value has dropped below the minimum threshold. Issue a margin call for $2.7 billion. The banker calls the client. Bill, the stock is down. We need cash to cover the margin by the end of the day, or we begin liquidating your positions. Hwang's lieutenants scramble to find liquidity. They ask the banks for forbearance, claiming they just need a few days to orderly sell off some assets to raise the cash. But on Wednesday, Viacom CBS plummets another 23%. For a normal investor, a 30% drop is painful. For Bill Hwang, operating with 10-to-1 leverage, a 10% drop means his entire equity is completely wiped out. He is mathematically bankrupt. The structural flaw of compartmentalized secrecy violently backfires. The prime brokers start looking closely at the portfolio. They finally realize they are not just dealing with a large client. The prime brokers realize that Archegos is the entire market for these stocks. This is the brutal math of the margin call cascade. If Morgan Stanley attempts to sell a block of Viacom shares to recoup their loans, the massive influx of supply drives the market price down even further. This triggers a secondary margin call at Goldman Sachs. Goldman then sells their shares, driving the price down again, which triggers a massive margin call at Credit Suisse. They are trapped in a doom loop. Because of the total return swap contracts, the banks legally own the plunging collateral. They are the ones taking the physical losses on their balance sheets, while Hwang hides behind the corporate veil. By Thursday afternoon, the banks recognize that a fire sale is inevitable. The first bank to sell will take a haircut, but they will survive. The last bank to sell will be left holding billions of dollars of worthless stock in a broken market. The race to the bottom officially begins in the dark pools. This brings us back to the Thursday night video call. Credit Suisse pleads for an orderly unwinding. They hold the largest exposure, with nearly $24 billion in total swap notional value. They are completely dependent on the goodwill of their rivals. But Goldman Sachs does the math. They recognize that a standstill is mathematically impossible. The market is already catching the scent of the distress. If they wait, the short sellers will front-run them. While Credit Suisse executives draft proposals for cooperation, the trading desks at Goldman Sachs and Morgan Stanley are quietly dialing their most aggressive hedge fund clients. They are preparing to dump tens of billions of dollars of collateral before the morning bell even rings. Credit Suisse assumes they have a gentleman's agreement, completely ignoring the fundamental rule of Wall Street. When the music stops, you make sure you have a chair, even if you have to break the legs of the person sitting next to you. The Friday massacre is locked in. Friday morning, March 26th, hours before the New York Stock Exchange opens for public trading. Goldman Sachs executes massive block trades in the dark pools. They dump $10.5 billion of Baidu, Tencent Music, and Viacom CBS shares at heavily discounted prices to hedge funds willing to absorb the risk. Morgan Stanley instantly follows suit, executing roughly $8 billion in block trades. They suck all the available liquidity out of the market. When the public markets open at 9:30, the tape reflects an absolute massacre. Retail investors watch in shock as billions of dollars in market capitalization simply evaporate into thin air. Inside the Credit Suisse offices, executives are completely paralyzed. According to the internal investigation, the bank's trading departments are bogged down in bureaucratic inertia. They spend hours debating the protocol, seeking legal approvals from executives in Zurich, and worrying about internal trading rules. They are holding committee meetings while the building is burning down around them. By the time they finally hit the sell button, it is too late. The trader in New York screams at the screen, "There are no buyers left! Goldman took all the bids!" The risk officer in Zurich replies, "Sell it at the market price. We have to stop the bleeding." But the market is completely broken. Credit Suisse is forced to dump their collateral at absolute fire sale prices. The loss is immediate and staggering. Goldman Sachs manages to escape with immaterial losses, having front-run the panic. Morgan Stanley loses roughly $911 million, a painful but survivable hit. Nomura loses nearly $2.9 billion. And Credit Suisse announces a catastrophic loss of $5.5 billion. It is one of the largest trading losses in the history of banking. The loss completely wipes out the bank's entire profit for the previous year. It severely erodes their Tier 1 capital ratio, the core measure of a bank's financial strength. The chief risk officer and the head of the investment bank are immediately fired. But the bleeding does not stop. The $5.5 billion loss is just the physical trauma. The psychological and reputational damage is terminal. Institutional clients and foreign governments look at Credit Suisse and lose all faith. They see an institution that was completely manipulated by a single family office using basic derivatives. A slow-motion bank run begins. Wealthy clients continuously pull their assets from the bank over the next 2 years. By March 2023, amidst a broader regional banking panic, Credit Suisse's liquidity dries up entirely. The stock price plummets to pennies. Fearing that the collapse of a systemically important bank will trigger a global depression, the Swiss government forces a shotgun marriage. Credit Suisse is acquired by its bitter rival, UBS, for a fraction of its historical value. After 167 years, Credit Suisse ceases to exist as an independent entity. Bill Hwang is later convicted on 10 counts of racketeering and market manipulation. His $35 billion fortune is gone. He faces decades in federal prison for marking the close. The death of Credit Suisse stands as a permanent tombstone, reminding the market that leverage, combined with secrecy and incompetence, is an uncontrollable weapon. But the chilling reality is that the underlying mechanics of this disaster remain largely intact. While the regulators have proposed new rules to monitor security-based swaps, the fundamental loophole that allowed Archegos to exist in the shadows is still open. Family offices managing billions of dollars of private wealth continue to operate outside the strict reporting requirements of hedge funds. The deep pools of hidden leverage are still circulating through the prime brokerages of Wall Street. The banks still chase the massive commissions, relying on risk models that fundamentally misunderstand human greed. The system has not changed, it has merely absorbed the shock. If you want to stay ahead of the next structural failure and understand the hidden mechanisms before the margin calls begin, subscribe to the channel. The next invisible whale is already swimming in the dark pools. The only question is, which bank they will drag down next?